Thank you, and welcome to The Briefcase, where we talk all things business, investing, and real estate. Today, we're going to be getting into the billion-dollar blueprint of apartments. Let's get into it. There's a reason the wealthiest investors in the world don't argue over single-family homes. They quietly accumulate apartment buildings, not because they're flashy, not because they're single, but because apartment buildings follow a completely different set of rules. Rules that, once understood, allow you to scale income, control risk, and manufacture value in ways that feel almost unfair. And yet, most people approach multifamily real estate like it's just bigger houses. It's not. It's a business, a numbers-driven system based on cash flow engines that rewards precision and punishes ignorance. So in this video, we're breaking down exactly how apartment investing works, from acquisition to exit. No fluff, no theory, just the blueprint. Why apartments dominate commercial real estate? Let's start with a simple question. Why apartments? Why not office buildings, retail centers, or industrial warehouses? The short answer, demand. People always need a place to live. They don't always need a new office, or retail storefront, or warehouse. Apartments sit at the intersection of necessity and scalability. You're not relying on one tenant. You're relying on dozens, sometimes hundreds, which means one vacancy doesn't kill your income. That's called risk distribution. If a 100-unit building loses 5 tenants, you're at 95% occupancy. If a retail strip loses an anchor tenant, congratulations, you now own a very expensive ghost town. Apartments are resilient, and in uncertain markets, resilience is currency. The economics of multifamily. Now here's where things get separate from residential real estate. In single-family housing, value is largely determined by comparable sales, what nearby homes sold for. Apartments don't care about comps. They care about income, specifically how much income the property produces. This is the first major shift in thinking. Apartments are valued like businesses because they are businesses. Every unit is a revenue stream. Every expense is a lever. And every decision affects profitability, which brings us to the single most important number in apartment investing. Understanding net operating income, or NOI. This is the heartbeat of the deal. Net operating income is simply income minus operating expenses, not including your mortgage. Let me say that again, because this is where beginners get tripped up. Net operating income does not include debt. It's purely the property's performance. If your building brings in $1 million a year in rent and costs you $400,000 to operate, your net operating income is $600,000. That number determines everything: value, financing, and investor interest. And here's where things get interesting. If you increase net operating income, you increase the value of the property, even if the building itself doesn't physically change. Which leads us to cap rates explained. A cap rate is how the market prices income. Think of it like this. If investors are willing to accept a 6% return and your property produces $600,000 in net operating income, then the property is worth $10 million. Now here's the key insight. If you increase net operating income by $100,000 at the same cap rate, you just added roughly $1.6 million in value from $100,000. That's the leverage of commercial real estate. Small operational improvements, massive valuation impact. This is why experienced investors don't just buy properties. They buy inefficiencies. How deals are actually found. Now, contrary to what Instagram might suggest, great deals are not sitting on Zillow waiting for you. Most serious apartment deals are off-market, broker relationships, or institutional pipelines. This is a relationship-driven business. Brokers control access, and they prioritize buyers who can close, which means credibility matters more than curiosity. You don't get deals by asking for them. You get deals by being known as someone who executes. Financing, the leverage game. Here's where things get powerful. Apartments are rarely bought with all cash. They're bought with leverage, typically 60 to 80% debt, meaning you control a $10 million asset with maybe 2 to 4 million of your own capital. That's not just leverage, that's amplification. If the property performs well, your returns are multiplied. And if it performs poorly, well, leverage works both ways. And that's why underwriting, accurately analyzing the deal, is everything. Value add strategy. This is where most wealth is created. Value add investing is the process of buying underperforming properties, improving them, increasing income, and forcing appreciation. Common strategies include renovating units, increasing rents to market level, reducing unnecessary expenses, and improving management efficiency. It's not glamorous. It's operational excellence. You're not guessing. You're executing a plan. Renovations and rent growth. Here's a simple example. You spend $8,000 renovating every unit. That allows you to increase rent $150 per month per unit. That's $1,800 per year per unit. Now multiply that across 100 units. You've just added $180,000 in annual income at a 6% cap rate. That's a $3 million in value from renovations that only cost 800 grand. This is why apartment investors obsess over unit upgrades and not about aesthetics. It's about math. Risk factors. Now let's talk about what can go wrong, because plenty can. Interest rate risk, vacancy spikes, poor property management, overestimating rent growth, and unexpected capital expenses. The biggest mistake? Overpaying based on optimistic projections. Hope is not a strategy. Assumptions need to be conservative because the market doesn't reward optimism. It rewards accuracy. Property management reality. Here's something most people underestimate. Apartments are operationally intensive. Tenants don't just pay rent. They call, they complain, they break things, they move out at inconvenient times. Good property management can make or break a deal. Bad management can destroy value faster than almost anything else. This is not passive income. It's delegated income. Exit strategies. Finally, how do investors actually get paid? 3 main ways: cash flow during ownership, refinancing, or selling the property. The ideal scenario, you increase net operating income, refinance, pull out your original capital, and continue owning the asset. Now, you're playing with house money. That's the real game. Apartment investing isn't simple, but it is logical. It rewards those who understand the system and punishes those who don't. This isn't about luck. It's about leverage, operations, and disciplined execution. If you can master those 3, apartments stop being buildings and start becoming vehicles for income, scale, and long-term wealth. And once you see it that way, you can't unsee it. And thank you for sticking with the briefcase today. If you found any of those facts about apartments confusing or insightful, please leave a comment down below. If you enjoyed this video, make sure to like and subscribe. Now remember, stay smart.